Good afternoon. Welcome to ASK Investment Managers conference call, quarterly update on domestic resurgent fund. I am Prashant. I'll be your moderator for today's call. We'll just wait for 2 minutes and start the call. Good afternoon. Welcome to the ASK Investment Managers quarterly conference call. Today we have with us Kuldeep Gangwar, Portfolio Manager, ASK Domestic Resurgence Fund. Let me give a brief introduction to Kuldeep. Mr. Kuldeep has more than 18 years of experience, including more than 15 years of experience in equity markets. This experience includes more than a decade in the sell side of equity research. His main domain expertise is consumer, FMCG, and retail. Prior joining to ASK, he was associated with HSBC Securities and Capital Markets India Private Limited. He has also worked with Tata Motors for 3 years. Mr. Gangwar has an MBA in finance from IIT Bombay and BTech from IIT Roorkee. He is also a CFA charter holder and is joined ASK in January 2018. So welcome, Kuldeep. I request you to take us through our market view, update on domestic resurgent fund, and we will have a Q&A session at the end. I request all the participants to type your questions in the Q&A box. Over to you, Kuldeep.
Good afternoon, everyone, and welcome to all of you. So we will start the session with the topic what probably we were discussing in March 23. At that time, there were a lot of negative news around, like whether it's inflation, interest rate, fears related to recession in the developed market, high debt. There were concerns regarding the weather, deteriorating relationship between the two major global powers. So those things do persist as we speak, but the things are improving at the margin. So if we look like commodity prices, whether it's a crude oil, metals, or say farm input prices, everything is coming down, which is a good news. Like it influenced the inflation, it influenced the decision makers part, whether they have to raise the interest, they have to maintain the same, and so on. So if we look crude oil, it has come down by more than 40% in last 1 year, 3 months. Like it made its peak in February 22 at the time of Russia-Ukraine war. This is another chart, like you can have a look that freight cost is also coming down. So from any company perspective, operating expenses do depend on like what is the freight when they're importing something and so on. So it's normalizing. It's almost 90% down from its peak and quite close to the pre-COVID level. Food index also is coming down. If we look summary, like global inflation peaked out, say 6 months back, it's inching downward. And most of the central banks have raised the interest rate in the interim period. We do believe that interest rate cycle has peaked out to some extent. It's a matter of a month or two that Fed should also take a pause. And if it's the case, then probably from narrative perspective, we are seeing a scenario that worst is over and it's all about how the inflation is moving forward, what's the pace of, say, consolidation and so on. But narrative is changing for good, like worst is over and at the margin, the things are improving. If we think about India micro situation and the macro situation, both are looking good. From macro perspective, if we look like subsidy bill will be coming down. There are many levers available, whether it's China plus one, and in recent time, people are also talking about Euro plus one. We had taken certain initiatives in last 3-4 years, like providing incentive to the manufacturing. Manufacturing as a proportion of GDP, we know, is close to 14%. And expectation is that it should be the driver of the growth in this country. Capacity utilization has already reached to a point where the incremental capex will be required from the private side. Net overall situation is looking quite good. When we think about macro perspective in the country, we already know that GST as a proportion of GDP is rising. Almost double-digit growth happening YOY basis month after month. Fiscal deficit peaked out, say, 2 years back at the time of COVID, and now it's moving in a direction which is more desirable. Direct tax collection is also increasing, and so is the case with the government capex. So when the government capex is rising, it's having multiplier effect. It does provide a tailwind for the infrastructure. It does provide a tailwind for the job availability in the country. Next, if we look, say, overall 10-year bond yield, it's coming down. It's already peaked out a couple of months back. It's close to 7% now. Inflation also peaked out, say, 6 months back or so. So even the same is the situation with the forex reserve, like we bottomed out about 7-8 months back and now inching up. Point is, like if we look global scenario, within that picture is improving across, or I would say it's not worsening anymore. In that particular scenario, India is emerging as a bright spot in terms of more certainty, more predictability for the growth, and it's broad-based. So if we think about Indian situation, the credit growth accelerated in last couple of years. It's more driven by the retail growth. And today, credit growth is higher than the nominal GDP growth. When it does happen, it suggests that the economic activities are improving. And when the system level growth is decent, the participants which are in the area like private banks, better retail, NBFC, they generally do better. And that's the reason we would have seen that most of the BFSI sector companies had done quite well in past. It's a summary of the, say, India situation. Like I mentioned, CPI already peaked out. In fact, it's within the comfort zone of RBI. And that's the reason we have seen in April, RBI decided to take a pause and the repo rate are close to 6.5% now. This pause led to a belief in the market that for India, at least the things are improving. And that's the reason we have seen a decent pickup in the overall market. When all this is happening, it's a snapshot how the corporates are responding. So if we look at by 19 to 23, corporate earning growth was quite decent, like high teen CAGR in last 4 years. And we do believe it should continue in coming years as well. But if we think about the market and look the long period history, Even if we say that market do chase the earning growth, which happens to be true. In last 30 years, almost 12% compounding for earning and almost similar sort of, say, stock market index performance. At the same time, it's quite visible that it does not have a linear relationship. There are times when the earning growth is superior and market performance follow. That had been the case during FY19 to 23 as well. Like earning growth compounding at the market level was close to 19% CAGR, whereas say market performance was only 11% CAGR. Why it happens? Because at any given point of time, either stock performance or market performance is combination of two things. How the companies are performing on ground, like what is the earning growth, and second, how the market value those earning. So in near term, there may be many noises involved, there may be short-term sentiments involved, and that's the reason earning growth may not be getting fully appreciated. This is something happened in last 1.5 years. Though the earning growth was quite superior, at the same time, the stock market was not responding in kind. Reason was that the FIs were withdrawing the money, and it led to a situation that market performance was underperforming the fundamental performance. It has changed in last 3 months. We have already seen since March onward this decent inflow happening in the Indian equity market from foreign portfolio investor, and that's the reason same earning growth, same performance is now getting appreciated in last couple of months. After having say last 2 decent months, this is the chart which reflects the 12-month trailing P for the overall market. It's currently close to 21.8, which is quite similar to 10-year average. I will like to highlight that theoretically, the multiple should be higher than the 10-year average. Reason is that the mix has changed in the favor of high quality, high growth companies in last 10 years. So 10 years back, a large part of the component was driven by more oil, metals, PSU banks, which generally command the lower multiple. Vis-a-vis now, decent part is coming from say consumer companies, NBFCs, private banks, which generally command a higher multiple because they offer the superior growth. So theoretically, the valuation multiple can command relatively higher multiple vis-a-vis a 10-year average. Nonetheless, even if the multiple remain where they are, there is high likelihood that earning growth will translate into the stock return. So if we believe that the overall market may grow at low teen to mid teen, there is high likelihood that it can translate into say decent return in coming years. There may be some quarter-on-quarter variation, but when we think say 3 years perspective, 5-year perspective, we remain confident about this part for one simple reason, that at any given point of time, the core requirement is earnings. As long as earnings are coming, then rest of the two parameters, whether it's a narrative or valuation, do get corrected over a period of time. So if narrative is negative for a while, the way it happened in last 1.5 years, it will change the moment we start thinking that the worst is over. And by the time, say, market is not responding to earnings, the valuations are coming down. Net, as long as the earnings are coming and stock market is not responding, probably that is a time that we will like to believe that the good stuff available at the relatively lower prices and probably more visibility from future return perspective. If we think about DRP, Domestic Resurgence Portfolio, last quarter operating performance was quite decent, like 24% operating profit growth and EPS growth, significantly higher than the market growth. We do believe it should continue, like in FY24 and FY25 as well, we expect 20% plus earning growth, vis-a-vis a market earning growth of close to 13 to 15%. And it's not about say Q4 FY23, it's not about FY23. It had been the case even in past, like if we think about say 5-year perspective, so these companies have delivered more than 20% earning growth overall in past. They have delivered in recent past as well, and it should continue. So that's the reason the core fundamental requirement for any investment, that earnings should be in place. It had been the case with the DRP portfolio. Like earnings were coming for last 5 years, earnings are bound to come in coming years as well. If that is the case, then this is the chart we should look at. Like current trailing multiple of DRP is at the lowest point experienced in the last 4 years. Almost a third of correction happened in last 1.5 years in terms of the multiple. And this particular period has seen all, like whether it was a ILFS related issues, whether general election, whether COVID-1, COVID-2, Russia-Ukraine war. So whatever same multiple we have experienced on the lower side, probably we are seeing almost similar multiple as we speak. If that is the case, then the probability increases that the if earning growth is coming and it's a decent one, then high likelihood that it will translate into the stock return as well. Point I'm trying to highlight that either at portfolio level or at a company level, return is combination of two things: earning growth and valuation multiple. And last 1.5 year valuation multiple has come down to the level like it appears that it's quite close to the bottom. Then going forward, the scope of say earning translating into the stock return is relatively superior. And as I mentioned, that it's all driven by earning growth. So Q4 FY23, we have seen quite decent earning growth coming across all the portfolio companies, barring a couple of exceptions. If we think about, say, sectors, so consumer had a mixed bag. Some of the companies did not have a decent number. But net, what we are able to observe that margins are improving, given, say, commodity prices have come down, inflation has come down. Hopefully, as the rural revive, then the top line should also come. When we think about lending businesses like banks and BFC, they had quite decent quarter because credit growth was quite good. And as I mentioned, that better rated banks and NBFC registered superior performance. And we believe it should continue in time to come as well. As far as engineering and infrastructure is being concerned, so CapEx activity is increasing and its reflection is there in the numbers as well. IT is one of the areas where there had been some shortfall vis-a-vis say expectation. It may there for FY24, but IT exposure, we have very limited exposure for the IT overall, say low single digit. So this is a psychographic. If we think about DRP, DRP is having almost 70% portfolio coming from say consumption and financial. When I say consumption, it includes say staple, discretionary, part of it retail, jewelry, so consumer durable. Every facets of the consumption part is being covered over here. We remain quite confident that this is the part which continue to benefit from the tailwinds like unorganized to organized, premiumization, lifestyle changes, and so on. When we think about financial, it's quite similar to the benchmark. The only thing is that we have relatively higher exposure toward the NBFC part. And this is the area where confidence level remain quite decent in terms of upcoming earning growth. And valuation multiples are also quite reasonable vis-a-vis their own history in past. Next is like telecom, software services, platform company. We believe, say, telecom and platform are the area which are the more future for this company, for our country, and that should also continue to do well. Manufacturing, as I mentioned, that this is a focus area for the government, and as we speak, close to 14 to 15% GDP is coming from the manufacturing side. Aspiration is that manufacturing contribution should increase to 25% in medium to long term. If it's the case, then this is the area where a lot of action will be happening, and that's the reason we have taken a sizable exposure in that particular domain. Specialty chemical is another area like post-COVID. Chemical sector became from more episodic to more compounding nature. Like many companies are signing long-term contract. So earlier, this area which used to be more commodity driven, it has changed to it now is providing a lot of visibility in terms of the future earning. So that's the reason we have some exposure in this domain as well. Net financial consumption and manufacturing are the overweight area for the DRP strategy. This is a snapshot of earning growth and the PE. Valuation have become reasonable while the earning growth remains quite superior. If we think about, say, a portfolio performance, so if we look at CY19 or CY21, 3-year CAGR was close to 21%, vis-a-vis 19% for the BSE 500. CY22 was a year where this particular portfolio underperformed for reasons that growth as a style took some beating because there were many things happening globally. Interest rates were rising, so return expectation when rise, it increases the discount rate factor. It does impair the valuation of the growth stocks. So what this particular strategy experienced, that was a case across the growth strategies. So CY22, we did suffer some performance issue over there. But in CY23 till date, we have tried to recover part of it. Like so net, if you look, say, 3 to 4 year perspective, it's quite in line with the, say, BSE 500 performance. But it has more to do with that they had been last 1.5 years where the growth as a strategy was out of flavor. As I mentioned that today valuation are quite reasonable while the earning growth certainty is there. And if it's the case, then there is high likelihood that earning growth may translate into the stock return. So from medium to long-term perspective, we remain quite confident about, say, fundamental delivery and its a translation into the stock return as well. I will stop over here and happy to have any question.
Yeah, Kuldeep, thank you very much. We were talking about growth coming back. Do you see enough data now in last 1 quarter that this would be continuous and secular? I believe the valuations are cheaper there as compared to value as a philosophy. Your thoughts on that?
So, as I mentioned, for a stock market to perform or for a stock to perform, 3 things are required. One is the narrative. Narrative is like, what is the story? How the things are happening in the ecosystem. Second part is the earning growth, basically reflection of, say, fundamental. And third part is valuation. So if we look last 1.5 years, there were many negatives around, whether it's a geopolitical situation, its implication on, say, commodities, inflation, interest rate, and so on. So a lot of negatives around. That's the reason narrative was negative, which was pulling down the overall stock market performance. At the same time, earning growth was coming. As I mentioned that during FY 19 to 23, the earning growth was close to 19% CAGR at a market level. Our portfolio continued to do better, but fundamentals were intact, and we were emerging as one of the bright spots in the overall global arena. As negative narrative was pulling down the overall, say, stock market performance, it led to a situation that the valuation started coming down. As I already showed to you, that valuation have come down to the level what probably being experienced at the lowest level possible in last 4 or 5 years. So at March end, we were sitting at a scenario where narrative at a margin was improving, like negatives were known, but incremental negative were quite less. We were talking about inflation coming down, interest rate coming down, and so on. So narrative started turning to that worst is over and probably there's better time ahead. And the stock market is all about, say, future expectation, future cash flow. Earning support had been there all along, and given last 1.5 years, because the market was not performing, so valuation also become reasonable. As we think about FY 24 and 25, all the 3 things are in place, like decent narrative, decent earning growth, and reasonable valuation. That's the reason we do believe that that growth versus value, which was the case in last 1.5 years, probably that should not be significant drag going forward, and there is high likelihood that the earning may translate into the stock market.
Thanks, Kuldeep. We have a question. Why are we holding very overvalued stock like Pidilite? Should we not take our profits and find better avenues?
So if we look Pidilite is currently underweight position, close to 3% weight, which we are having. At the same time, when we look around, this is one of the company which is leader in its own space. And when we scan through, say, opportunities available, we come across that there are those 6,000 companies, but only less than 100 companies available, which are investable in a sense, like offering visibility, offering growth. Only issue come like what is the price? Obviously, it's a relatively higher on the valuation part, and that's the reason we are maintaining say underweight position. But at the same time, it's all about training. If we think about future, probably FY25, FY24 should be the year when the company will be reporting more than 40% earning growth. Because if you look about the cost structure of the Pidilite, almost 20% come from the VAM prices. VAM prices have come down by 50%. And its reflection has yet to happen in the overall, say, commodity input cost for this company. There will be significant margin expansion, there will be significant earning growth, and probably we do believe it should sustain even in years to come. So what we have seen in last 3-4 years, the earning growth was not coming because there was significant commodity pressure, which led to a situation that overall valuation started appearing on the higher side. It should auto-correct in time to come.
Thanks, Kuldeep. Kuldeep, next question is, will you add some IT companies as they are cheaper right now?
Come again?
So, Kuldeep, there is a question on IT companies. We had Infosys, and the Infosys results have been, for this quarter has not been great, while the mid-cap ITs have done very well. So, would you like to add, are you looking at IT mid-cap companies? That is one. And do you see that they are now correcting so they are cheaper? And would you want to increase the exposure?
So if you think about DRP strategy, DRP is more about India overweight. So export-led names, there are only 3 names as we speak, and overall exposure will be close to 10%. So we have avoided export-led name, whether it's a chemical, pharma, IT put together. We just go where we believe that we require some exposure in the respective domain. IT as a sector, if we think about it, realistic expectation should be high single digit to low double digit earning growth. This sector generates a lot of cash flow. They do pay out a lot of dividends and so on. The missing element is the growth part. And as we look, say 15% plus growth in this particular strategy. So we have tried to take some exposure, but not beyond a point. So we think we compare with a benchmark. Say BSE 500 would be having close to 12% coming from the IT side. We are having only 3% in this particular strategy. It has more to do with that domestic resurgence portfolio. It's more about India's story, like which are the area which can do well in time to come. As it happens in any economy, that there are certain sectors which do better than the underlying economy growth. So we have tried to spot which are those areas where the India should do well. And for rest of the areas, we have tried to have only some exposure. So it's more about a portfolio construct that we have tried to limit the export-led names in this particular strategy.
There's a question for domestic consumption. Are you not interested in consumer durables or auto exposure?
So consumer durable side, we have some exposure through Polycab. Though Polycab can be slotted as a manufacturing company as well, and so on. They are also venturing in the FMEG part of it. But we do believe we have decent exposure to the, say, consumption part. Close to 38% weight is coming from that area, which is close to 15-16% in the benchmark. And we have taken this exposure through the Polycab as we speak.
Thanks, Kuldeep. Kuldeep, some of the stocks in the portfolio, Varun Beverages has done extremely well, and the return for last 1 year is about 100%. What is your strategy now going ahead? Will you trim that position? How is that you will take it?
So as it happened that we keep on taking some profits on the table. So we did trimming in past. So as and when a position become outsized, we keep on exercising this particular option of trimming. At the same time, if you look around, probably this is one of the company offering quite strong earning growth, and that too for a length of time. So we do the trimming part in a disciplined way. And whatever exposure we feel is the optimal, we try to keep that much in the portfolio. So we have done the trimming in last 6 months in the Varun.
So there is a question on Patanjali. Yes, Patanjali has been, the stock has been volatile. And then there is a question on how this particular company as an FMCG will do well.
So we should think about Patanjali as a transformation company. Like in FY21, when the Patanjali Ayurveda acquired Ruchi Soya, which is a erstwhile Patanjali, at that time, 90% of the profit used to come from edible oil, which is a commodity in nature, relatively more volatile. This year, FY24, edible oil profit contribution will be less than 40%. And in coming years, edible oil profit contribution will come down to say 20 to 25% only. Balance close to 60% in FY24 and 75 to 80% in next 5 years should come from the FMCG part of it. FMCG was close to 6,000 crore revenue in FY23 with 18% margin. Our expectation is that this particular component can grow at close to 15% CAGR in revenue terms, while high teen margin is doable. If it's the case, then the mix for the Patanjali will keep on improving, and the contribution from the FMCG will keep on improving as well. Like more likely 25% plus should be coming from FMCG in revenue terms, and more than 2/3 coming from say profit terms in time to come. What happens, like if the nature of business is transforming that way, then the predictability quotient go up, certainty quotient go up, and the market perception regarding say company's ability to deliver consistent earning growth also change in favor. So this is something we expect that FY24 should be quite good year for Patanjali. Like in FY23, they suffered because of the edible oil volatility. If it's a relatively base case normal year for edible oil, at the same time, say FMCG contribution increasing up, we do believe quite significant growth happening in FY24 and beyond. So this business is transforming more in an area which is more predictable in nature.
Kuldeep, there is a question on the cash levels in the portfolio currently. Somebody has mentioned 5% cash levels. What is the plan to deploy?
So we had close to 3% plus at the scheme level. As on my end, we have already deployed in last couple of days.
Thank you, Kuldeep. The next question is, why is bank like HDFC Bank, Kotak Bank not moving and struggling?
So as you know, this HDFC Bank, HDFC Limited merger issue is going on. And what happened that there are two aspects to it. One is the fundamental, that how the combined company will be doing on ground. We believe that there should be reasonable earning growth expected from the group. There are technical factors also involved. Like if you look the overall exposure from the mutual fund side, there are many mutual funds which might be holding more than 10% combined, HDFC Bank and the HDFC Limited. As a technical factor, that as a guideline, they can hold maximum 10% of a particular company. So they have to cut down the exposure, not because of the merit of the fundamental, it is more technical factor. And when this a transition like this happen, sometimes the stock do underperform. At the same time, I mentioned that ultimately, if the earnings are coming, fundamentals are intact, price will follow. So I will be only concerned about if they are not able to deliver on ground. If they do, then it's more about that good stuff available at the cheaper prices.
Thanks, Kuldeep. There is one question on projection of earnings of the portfolio for this year and next year.
So for about 24 and 25, we expect 20% earning growth. More or less similar number what we have delivered in FY 23, more or less the same number what is been delivered in the previous years.
So there's a question on Page Industries. The results of Page Industries were not good for this quarter. So your view on that particular stock?
So Page Industry, we know they had the perfect past. There had been some concern about current situation, but at the same time, we believe that the future is still bright. Why we are saying so? That when the company is reporting number, they can be two things. One is the overall environment this company is operating. Second is company's own doing. So company reported 13% sales decline in Q4 FY23. It has more to do with that they are reorganizing the supply chain. If they were not doing this exercise, the revenue growth would have been flat. So while we can say overall demand scenario had been challenging, but not to the extent what the numbers were reflecting. So they are implementing some supply chain related initiative, already 6 months in the same, and probably this should continue for another couple of quarters. But by first half of FY24, this supply chain reorganization should be done. Post that, the number should start again flowing in. So we expect close to single-digit growth at top line level and close to double-digit growth at earning level in FY24, followed by very strong growth in earning in FY25. Because two things happen: normal demand scenario, efficient supply chain, delivering close to mid-teen sales growth, and the margin improvement, leading to a situation that we expect close to 25% earning growth in FY25. And post that, the mid-teen sort of number should be the realistic expectation. So whatever happening at the current juncture, it's a more of a reflection of a tough demand environment. At the same time, companies' willingness to get future ready.
Thanks, Kuldeep. There is a question on Berger Paints. More competition is coming in this space, like Grasim. How do you see the business growth going forward?
So we should think from the perspective that what if the Grasim was not there? So take an example that suppose 100 rupee is the market size now. It's a 10% compounding happening for 10 years. Now the Grasim come into the picture, and 10-year time frame they become successful. They take 15% market share. It means they take away close to 100 basis point growth from the incumbent. So incumbent like Asian, Berger, Kansai, etc., if they were supposed to grow at 10% CAGR as a combined pool, probably they will grow 9% because balance is being taken by Grasim. Next question should be asked, what the incumbents can do about this. So incumbents look for new area of growth. So in last 5-6 years, more or less, every paint company has ventured into, say, construction, chemical, waterproofing, and so on. So as long as management is looking for, say, future avenues, and they do recognize that obviously there will be somebody coming to your turf in terms of the increased competition and so on. But as long as they can come across a new revenue growth driver, we should be okay. And that is a thing we are looking at. Like we do believe these companies can deliver, say, low teen sort of top line growth when we think about, say, low teen to mid teen sort of top line growth. And margin should stabilize, say, FY24 or FY25 and beyond once the Grasim story is digested by the market. So there is enough scope, there is enough play available for everyone, and Grasim is coming in paint. At the same time, these paint companies are looking for alternative avenues like, say, waterproofing, construction, chemical, and so on. So from earning growth perspective, from, say, 5-year perspective, we do believe, say, mid-teen earning growth is quite plausible.
So there is a question on ICICI Bank, two parts to it. What's your take on ICICI Bank? Is there potential to compound from these levels? That's part one. Second question is, has it already been re-rated, and why not Access?
So you rightly mentioned that ICICI Bank has gone through the re-rating cycle. Again, in last 5 years, it's more about the faith coming into, say, bank's ability to deliver. So bank has delivered decent earning growth irrespective of what happened in the overall environment. They had pretty strong, say, earnings even in the recent past. And we believe that they have reorganized themselves and they are ready to take on in terms of opportunity available. So as I mentioned, if nominal GDP is growing at, say, low double digits, say 11%, or more likely credit growth will be happening slightly higher than the same, the low teen, then this pool of private banks and the NBFC should at least deliver, say, 15% plus, depending on which bank, which NBFC we are talking about. Number can be higher. So as we speak, if that is a number, earning growth should be in the range of 15 to 20%. We believe even if the current multiple sustain, we do not build any further re-rating. This high likelihood that this earning growth itself, this book value growth itself will translate into the decent return from the ICICI Bank. So in a base case, we are not building any re-rating from the current level. It's more about our confidence in their ability to deliver earning for next 5 years or so, which should remain quite superior.
There is a question, do we have minimum market cap requirement to consider as a stock? And do we take stocks with less than 15,000 market cap?
So we do take. So at times when we believe that there are the areas when the market leader itself is a small cap or mid cap company, we do go in those areas. So think from the perspective like APL of Apollo, we took in September 20, about 2.5 years back or so. It used to be a small cap company. Same was the case with, say, Redico. Redico today may be 15,000 crore, but when we first took, it was a small cap company close to 7,000 crore or so. Like it's more than doubled in last 1.5 years or so. So it's more about our confidence level, like whether it's an emerging area. If it's an emerging area, then which is a company who has right to win. If that leader itself is a small or mid cap company, so we are okay to be there. So I won't say that there's any minimum market cap criteria. It's more about, say, liquidity being maintained at the portfolio level, all the risk control taking factored in, like what we want to take in terms of the liquidity exposure and so on. So market cap is one of the area, but as long as it's offering high quality, high growth, we will like to be there.
There is a question, will pharma be never considered for this theme of DRP?
So as I mentioned that till last year, there was a restriction that we can't invest in a company where the export is more than 20%. That's the reason we did not have any IT company, chemical company, pharma company till beginning of 2022. We took approval to have up to 25% exposure coming from the export areas. And post that approval, we have taken, say, Reliance, Navin Fluorine. So I'm saying that pharma can come now because we have taken exception at the portfolio level. As and when we believe that it can add value to the overall portfolio rate. Earlier, we had the limitation driven by the portfolio construct till last year.
Thanks, Kuldeep. There is a question on monsoon season is around, how the rural demand is shaping in consumption.
So monsoon is there, but how the monsoon play out will come to in next couple of months. Hope is that it remain a normal monsoon as the IMD is predicting. If it's the case, then probably it should turn out that a decent crop and the decent income for the rural side. Then the rural demand should pick up. So last 1 year, inflation did say hit the rural and to some extent urban. Going forward, expectation is that if the monsoon is normal, it's leading to a decent agri income. The rural demand should also come back across sector and the consumption basket overall. So we will be having a lot more visibility in coming months that how the monsoon is playing out.
There is a question on we are in asset ASK is in asset management space.
Can you just
you are not considered? Why you are not
speak a bit louder? I am not able to get it.
You are able to hear me, Kuldeep?
A bit louder, please.
Yeah, Kuldeep, there is a question that why you have not considered any AMC companies in the portfolio, asset management companies.
So as a group, we keep on evaluating, say, opportunities available across sector and within sector, all the subsectors. So it's not about, say, consideration having reflection in the portfolio or not. We do evaluate across the basket, and whichever opportunity where our confidence level of earning growth is high, and where we believe that this earning growth will translate into the stock return, we go for those areas. So in case of AMC companies, we have seen that there had been many changes in regulatory arena. It's a developing area. Many things are happening in those areas. And obviously, it's having implication for, say, fundamental performance, earning growth performance for those companies. And if it's a case that many things are changing on, say, environment side, it does have implication for predictability of the earning growth in that particular area. So we keep on looking for different sub areas of any sector, but at the same time, to make a place within the portfolio, it should offer significant delta vis-a-vis anything we are holding as we speak.
There's one question on AU in terms of corporate governance, and there's a lot of rumor around it. Are you comfortable holding names, such names? Is the question.
And you're talking about AU Bank?
AU Finance, yeah, A small bank.
So it's very difficult to comment unless we know what rumor we are discussing, because in our understanding, that company is led by one of the finest entrepreneur who is having hunger. At the same time, AU is not a new company. They have a long history. It's all about they became bank, say, 4-5 years back. And to come this far and doing a business which is relatively tougher one, I would say, because if you look the exposure of AU, close to, say, 40% might be coming from wheel, another 40% coming from small business loan or so. It does require a rigor, it does require a passion, it does require discipline, and unless our processes are in place, it's very difficult to deliver the kind of performance AU has done in last many years. So post becoming the bank, it's more and more regulated entity, and there's regulatory oversight available, and we believe that they are doing good job, and that's the reason our expectation is that earnings should remain quite decent, and that's it. Like to the extent we know that nothing to our notice which should be, say, get concerned about.
Kuldeep, there is a question. We have a Polycab and KEI, both businesses in FMEG and cable wires. Why do we have two stocks in the same area of business?
So look from the perspective, like when we take BFSI exposure, we have many banks, we have many, say, NBFC. When we take consumption exposure, at times we can have many FMCG company or, say, consumer durable retail company. It's all about like which are the good company which can deliver sustained earning growth. It's not about, say, some that I have to take only one from this and that. It's more about which are the options available to us. As I mentioned, there are less than 100 companies available which offer everything like good management, good opportunity, good earning growth, and so on. As I mentioned, there are many sectors like whether BFSI consumption, we go for the multiple, say, opportunity in the same area. So it's the case with this KI and Polycab. Polycab is the leader in the cable and wire, and KI is the number 2 player, and both are doing quite well.
Thank you, Kuldeep. We do not have any more questions. So thank you very much for in-detailed presentation on outlook and the update on domestic resurgent fund. Thank you very much. Thank you all the participants. Kuldeep.
Thank you. Thanks a lot. Good day.
Thank you.